Now, talking about AS10, AS10 deals with property, plant and equipment. Now, if I have to talk from the student's point of view, this is one standard where students might feel a bit difficult to remember because the length of the standard is a bit more compared to other standards. So because of that, again, if at all it is on a chart based presentation, as I've already told you in the previous video, that we will try to have everything on a chart based presentation, so that once you look into the charts, you will quickly start recalling all the major points of the standard. So I will again try to bring that up. Just like in the previous day, I will try to bring that up again on a chart based mode. Again, I'll try to give you certain highlight points so that once you look into the standard, even though it's a bit wider one, you can make sure that you can concise it and start learning about it. Even from the explanation point of view, I have not considered it on a too vast basis, at the same time too less basis. I have taken the moderate version of explanation so that even from the revision point of view, it would be better for you to understand them. Now, coming to the point of AS10, it talks about property, plant and equipment. Before this, AS10 in the old version used to be called as fixed asset, but now after the revision, it has taken place as property, plant and equipment. The first thing, what are the coverage area of this particular standard? What are the coverage aspects of these standards? The first coverage of the standard is, how do you recognize a property, plant and equipment? That is covered here. Then how do you ascertain the carrying amount of property, plant and equipment? Now carrying amount basically means book value. How do you derive them? Third one, it talks about how do you go for depreciation mechanism. So earlier there used to be a standard called as AS6, but now it is not there. Even depreciation is covered by AS10 itself. Finally, if there is any impairment loss, how it is affected. So only impairment loss effect is covered over here. Calculating how impairment loss might happen, that is covered by AS28. Over here, once if there is an impairment loss, how do you bring that up in the books of accounts is covered by AS10. So this is about the coverage area of the standard. One by one we have to see. So starting with recognition, then measurement, then depreciation, then impairment. Now, the first requirement of property, plant and equipment is, what is the scope and coverage? Or I would say scope and applicability. What is the scope and applicability of this particular standard? Now, first, when it comes to scope, point to be remembered is, this is a general accounting standard. So this basically means that it is a standard where specificalities are not involved. Generally, if I want to know about how do you account for a property, plant and equipment, it is directly coming over here. Come to this standard, learn about it. Which means if there is any specific accounting standard which is going to deal with the same topic, refer that standard and do not come to this standard. Okay, if I have to give you an example, it is AS19. So if there is a lease asset, if there is an asset involved in leases, at that time the standard tells go and check AS19 first, because AS19 exclusively talks about lease and how do you deal with asset based on lease. If AS19 gives any reference to AS10, then that's different. But if there is directly connected to AS19, go and check AS19, don't come to AS10. So AS10 is basically a general standard. So wherever specific accounting standard is applicable, general accounting standard does not come into the picture. That is the scope of this particular standard. Then the applicability point of view. Is it applicable to everything? Now we say that applicability wise, it is applicable to all tangible assets, but it is not applicable for two things. So for what and all not applicable effect will come? So it's not applicable for one, biological asset, and second one, wasting asset. But the standard doesn't stop here. It tells all tangible assets, but it does not apply to biological asset except bearer plant. Okay, so which basically means that AS10 PPE standard does not apply to biological asset. In that biological asset, there is an exception of bearer plant, which means for bearer plant, it is applicable. So for bearer plant, PPE is applicable. For other biological assets, it is not applicable. Then wasting asset. Now, what do you consider under wasting asset? So wasting asset basically are these minerals, then oil, then gas, etc. So that why it is considered like this? Basically, it loses value after extraction. Loses value after extraction. We call this as non-regenerative. So once you extract minerals from the field, then that particular land loses its value to a large extent. So these things will be called as wasting assets. So applicability wise, not applicable to biological, not applicable to wasting. In biological, exception of bearer plant, which means for bearer plant, PPE is applicable, AS10 is applicable. Now, we will see those particular definition then. So two problems came into the picture. Now, wasting asset, we saw the meaning. But two words or two terms we need to know now. One, what do we mean by biological asset? Two, what do we mean by what do we mean by bearer plant? So now first look into what do we mean by biological asset. What do we mean by biological asset? So basically any asset having life will be called as biological asset, as simple as that. So which means in biological asset, two things came into the picture. One is living animal. If it's dead, it is not covered here. And plants. Okay, living animal and plants are covered for biological asset requirement. Now, for the current time being, there are no standards which is given on agriculture to tell about livestock and all. There are no accounting standard which is applicable right now. So, normal general accepted principles are followed when it comes to these elements. But one hint is given in the material as well, saying that if at all till they introduce an accounting standard on agriculture, if these biological asset comes under the definition of PPE, then we can cover that up under AS10 for a temporary basis. But yes, we need not consider that in that detailed extent. But for biological asset coverage point of view, animals and plants, animals from the definition point of view or the applicable point of view are totally excluded. Other plants are excluded but for bearer plant, it is applicable for PPE. So for plants, what is happening then? Bearer plant, AS10 applies. Others, not applicable. And living animal, not applicable for the time being. So this is how the applicability element of biological asset is coming into the picture. Now what about bearer plant? So what do we mean by bearer plant in a given scenario? Now, to be called something as a bearer plant, we have to see certain terms, we have to understand those terms, and then it is very easy for you to understand them. So first I will tell you the terms involved in the definition, and afterwards I will tell you what are we supposed to consider under this bearer plant and an example just to understand them. So bearer plant perspective, how it is supposed to be considered. They are obviously plants first used for production or supply of what? Of agri produce. So these plants are supposed to be used to create an agricultural produce. Okay. Then this is going to bear produce for more than 12 months. And these plants cannot be directly sold in the market except scrap sales. So this is how bearer plant has been defined. Few students gets confused with these definitions and all. So initially I'll just tell the understanding of the definition and then we will take up an example. So first, it is supposed to be a plant which is the produce. It is going to produce agricultural requirement or agricultural produce, and it is the produce or this plant could be utilized for more than 12 months, and this particular plant cannot be directly sold in the market except for incidental scrap sales. Now, example wise, take any trees or plantation to that manner. Example, say you take coconut trees. Okay. Now, do you directly sell the coconut tree? No. Do you directly sell the coconut tree? Obviously not. Instead, what you're going to do, you use coconut tree for production of coconuts. So check the first part of the definition, used for production or supply of agricultural produce. So what is agricultural produce? Coconuts. And these trees are utilized for these coconuts. Okay. Then after that, what they say, these plants can be able to produce for more than 12 months. The answer is yes. One coconut tree will have so many years of life, so it can automatically used for more than 1 year. So there is no problem at all. And these trees cannot be directly sold in the market. Obviously not. These trees will not be directly sold in the market. However, say these trees have turned really old. So what anyone normally does, if the trees turn old, they cut the trees and they use them as firewood or anything like that. Now those things are excluded. That is okay, because once it turns old, produce doesn't come out. So they cut the tree and they use it for firewood or something like that. Now that is fine. But directly, whether the intention of the business is to sell those trees itself, no. The intention is to use coconuts and sell them in the market. So therefore, these things became bearer plant. So that's how bearer plant can come into the picture. So any tree you take to that manner or any plant you take to that manner, first the life should be for more than 12 months. Then it should be used for the produce, and very important point, plant cannot be directly sold in the market. So if at all there is a particular business people where the intention itself is to create or is to grow a tree for firewood purpose, now at that time those trees are never going to be bearer plant, because the intention itself is to cut the trees and sell them. So those things are not covered. Other things like incidental ones are totally fine, and it should mainly be utilized for produce and not directly sold in the market. So that's how you have to consider a bearer plant definition. Now once the bearer plant requirement is over, we have to take up one of the very important thing of this particular standard. What is the definition of PPE? What do we mean by property, plant and equipment in the first place? Now first, there are two major definition requirement of PPE. Number one, what is the usage part? Used for. And what is the duration? So first, what is the purpose for which you need to have this particular asset? So first, PPE applies to all tangible assets. So they are all tangible asset which are used for. Intangibles are not covered here. Intangibles are covered in AS 26. Used for, there are three things which is available according to the definition. Used for production or rendering services, Second, for rental to others. Third, for admin purpose. So purpose are of three types. Either you use it for production to produce the goods or to render the services. Second, for rental to others. Third, for administration purpose. For example, say I'm now using a laptop. Now if I'm using a laptop, I'm using this laptop to render the service. So automatically used for rendering the services. I use laptop in my office. I'm using it for administration purposes. So all these things are covered for usage, and duration should be more than 12 months. So if that is the case, it comes under the definition of property, plant and equipment. So that's how you have to consider the entire PPE definition. If it comes within the definition, fine. If it doesn't come in the definition, its AS10 itself will not be applicable, because AS10 is applicable for property, plant and equipment. Now, once that is done, once it comes under the definition of property, plant and equipment, the next important thing is, what is the recognition criteria? If you remember, the first coverage area of AS10 was the recognition part. How do you recognize it? Recognition criteria, two major conditions given. One, probable future economic benefit will flow to the enterprise. FEB, future economic benefit. Then cost is reliably measured. Okay, so two major conditions for recognition purpose. This particular asset should provide you future economic benefit, and cost is reliably measured from this particular asset. Example, say you purchase an air conditioner. So that is used for factories, for example, for cooling purposes. So because of that, the produce can happen properly. So there is a future economic benefit. You bought it from an electronic shop. There is a cost for it. There is two recognition criteria. Recognize this particular air conditioner in the books of accounts. So that's how recognition is supposed to happen. Now, whenever a question is asked or anything like that, first look into whether it comes within the definition of PPE. Second, whether it could be recognized or not. So these are the recognition criteria which you need to understand. Okay. Now, when is the recognition aspect going to come in our situation? Now, the recognition aspect can come in two ways. One, it could be considered for our initial recognition or subsequent recognition. Now, what do we mean by that? Now, whenever there is a property, plant and equipment, either the recognition mindset might come at the beginning itself. What is that? Initial. This is what? Purchase. Okay. Second, after you purchase the asset, you may have to do certain other cost over the life of this asset. That will be called a subsequent. Now, subsequent, either there might be replacements, there might be servicing, additions, etc. All these things will be considered as subsequent recognition. So initial recognition, buying time, how do we deal with it? Subsequent recognition, if there are any sort of additions as such, how do we deal with it? Now, purchase, initial recognition and all these things, first consider the recognition criteria and that's it. How do we measure the cost? We will see a bit later. But in subsequent recognition, major problem which is going to come is, should I capitalize the value or do not capitalize? That is one of the major problem which anybody would face. So for that purpose, there are certain rules given by the standard. So whether it could be capitalized or whether it shouldn't be capitalized. So now I will mainly deal with the subsequent recognition part. The first one is day-to-day servicing. So once you purchase an asset, there will be day-to-day servicing to this asset. Now, should I capitalize those servicing costs which I am going to incur, say maintenance cost and all these things? Should we add it up to the asset? The standard says no. Do not capitalize. This comes under do not capitalize aspect. So what should I do then? If there is any expense, shift that to P&L. So all these expense incurred for day-to-day servicing, shift it to P&L because it doesn't give you any sort of economic benefit. It is done to retain them. So therefore, transfer that to P&L. The second one, if there are any replacements. If there are any replacements. Now, if there are any replacements, then you are allowed to capitalize provided recognition criteria is met. Okay, so you are allowed to capitalize it provided recognition criteria is met. So if replacement it doesn't lead to future economic benefit, then do not capitalize. It leads to it, then capitalize. Okay, now whenever capitalize aspect is going to come, then what are we supposed to do? Two things are supposed to be done. What is it? The new replacement add the cost to your main asset. Okay, say main asset value is 1 crore. One replacement of 10 lakh is done. A small part, 10 lakh is the cost of it. So one replacement has been done. So what can be done? The new cost what you have incurred, that particular part, you add it up. You add that cost to your main asset. And what about that old part? The old part should be derecognized. Coolant has been replaced. Okay, well, for the large machinery, a coolant has been replaced. Now, this coolant, whatever has got replaced, number one, the new coolant cost will be added to the main asset. The carrying value of the old coolant will be derecognized. So, what are you going to derecognize? The book value. Book value of what? Book value of that part. That has to be deleted. Otherwise, what happens? It will be double capitalization. So, for that purpose, they said you delete that part's book value, you add the new part's cost. So, that is how you have to deal with replacement mechanism under AS10. So, day-to-day servicing expense P&L. Replacements, it is allowed to be capitalized provided recognition criteria is met. If you are capitalizing, cost add, old part derecognize. That's how it should be done. Now, let's move towards the next part of the standard where measurement aspects comes into the picture. How do we measure the values involved in property, plant and equipment? First, either it will be at recognition, which is your initial recognition part, or after recognition, which is subsequent part. So basically, after recognition talks about carrying value. At recognition mainly talks about initial value for that asset. Okay, so at recognition and after recognition. Now, at recognition, I will directly show it up with a different chart itself. At recognition, we should always approach cost model. So basically, what do we mean by cost model? Any cost incurred to bring that asset up, that will be added or that will be considered as the value of the asset. Okay, so you have to bring up cost model in that particular situation. Now, this particular at recognition can be considered in three ways. One, either you purchase the asset from the outside market or you are going to self construct that asset or you are going to go for some other requirement. For example, say you go for barter, transfer of asset with one another, all these things are covered under the last stage. Now, so at recognition where we talk about cost model in that purchase, self-construction and others. First, let's talk about purchase. So if I'm going to purchase the asset from a third party, how it is supposed to be done. For that, we say three costs are supposed to be added to bring the value of the asset. One, purchase price. Two, directly attributable cost. Three, decommissioning. Or dismantling. Or restoration. Okay, so three types of expenses are covered. Add these three will be your value of asset for the purchased PPE. So first, any purchase price. Second, directly attributable cost. Third, decommissioning, dismantling or other suitable restoration charges. Now, purchase price, what are the inclusions we are going to have? Number one, the price of this particular product. Second, if there are any freight or carriage. Third, if there are any duties and taxes. Again, the same stuff, there cannot be any refund or no credit. We have seen this in AS2 as well. The same thing is covered here as well. 4, if there is any trade discount, then deduct. This is your purchase price mechanism, whereby you have to consider it accordingly. Next, directly attributable cost, what you have will be again bifurcated. Now, there are certain directly attributable cost for inclusion purpose, which is they are the examples of inclusions under directly attributable cost, and there are certain exceptions or exclude. These things are supposed to get excluded. Now, first of all, what do you mean by directly attributable cost in the first place? It means any cost to bring the asset to present location and condition. This is the technical understanding of the term directly attributable cost. So it means any cost which is incurred to bring the asset to your present location and condition. Now, what are the inclusions under directly attributable cost? Number one, cost of site preparation. So to install the asset, you prepare all the site, the land needed. So that is cost of site preparation. Second one, if there are any installation costs. Third, if there are any assembly and handling costs. Fourth, if there are any trial runs, test runs. So just to see whether the PPE is within the permissible requirement, whether it is within the management specification or not, we have to check it up once. So those things, whenever you check, we call it as test runs and all. Now, any cost incurred on that again is allowed to check whether it is within our specification or not. 5, if there are any professional fees you are going to pay for it, even that is also a directly attributable cost. So these are certain inclusions what we find under directly attributable cost requirement. Next, what are the exclusions you have? What are excluded from the directly attributable cost point of view? Now, management has approved the asset, but still if there are any cost to bring into condition, those costs are excluded. Example, See, the management has approved for a particular asset. They made a trial run. Management looked into that trial run. Management said it is according to specification, so we are approving this asset. Again, you are trying it one more time just to get it confirmed again. This is not covered, because once management approval is done, once the asset is suitable for your approval, suitable for your business, it is already accepted. Again, just to see, just to bring out, just to see whether it is within for confirmation purpose, those things are not covered as directly attributable cost. Second one, if there are any initial operating loss. Third, if there are any relocation or reorganizing costs. Say the building is having a major structural change. Till the structural change is supposed to happen, you are relocating into some other place. Now, relocation cost, if there is any incurred, that is not covered under directly attributable cost, because that is not related to your main asset in the first place. That's only to continue your business. So therefore, exclude them from directly attributable cost. So these are the exclusions what you find under directly attributable cost. Again, we are still in the purchase mode. The last one is decommissioning, dismantling or other restoration cost. Now at the time of purchase or at the time of removal of the asset, from bringing in the asset till you remove the asset, if you do any decommissioning, dismantling or anything of that sort, now those costs are supposed to be included in the value of the asset itself. Say for example, after 5 years, you are going to dismantle your asset. You are going to break down your asset so that you can install another new asset. So dismantling the coming asset, the asset is yet to come. It will be used for 5 years and later it will be dismantled. Now that dismantled cost is also included in the current value of the asset itself. To that extent, even AS 29 comes into the picture, where suitable provision will also be created on that amount. So that is how this inclusion perspective is considered from the purchase point of view. So these are the purchase of asset point of view where this thing should be taken up. The next part is if I go for self-construction. So if the management goes for self-construction of the asset, then how it is supposed to be done? First, we can tell all cost incurred for construction, you can capitalize it. Since it is self-constructing of the asset, all cost incurred on the self-construction is allowed to be capitalized. However, there are certain exclusions. What are they? The first one is internal profits. Do not include internal profits in the value of the asset. Okay, example, say my business itself is dealing in computers. So my accounts team needs one computer. The normal selling price of this computer is 50,000 rupees. How is that 50,000? 40,000 cost plus 10,000 margin. So for an outsider, if you are going to sell the computer, you will sell it for 50,000 rupees. The same computer is used now in the accounts department. Now, should I recognize in accounts department also at 50,000? No. Why? Because that 10,000 is internal profit now. There is no actual profit involved. So therefore, exclude those internal profits. Consider only the cost. Do not consider the internal profit. Then exclude if there are any abnormal loss which you incur while going for self-construction. So for self-construction purpose, if there is any abnormal loss, exclude them. Third, if there is any interest which is incurred for the construction purpose, it is excluded. If at all it is covered by AS 16, it can be considered for inclusion. So if it is covered by AS 16, then no problem. It could be considered for inclusion. But if AS 16 excludes it, then even capitalizing the interest is also not allowed. So this is how you need to consider the self-construction. All the cost will incurred will be added. Yes, but Internal profit eliminate, abnormal losses you eliminate, and even interest cost to that matter has to be eliminated. Then what are those other circumstances? Even self-construction is also done. Now what are those other circumstances where you need to consider your cost analysis? Number one, if there is any payment beyond credit period. Okay, if there is any credit period, if there is any payment which is beyond the credit period. So credit period given was for 3 months. You are making payment after 8 months. Now what is the impact? Impact is interest will come into the picture. Now for that reason they say interest exclude. Again, wherever interest comes into the picture, AS 16 has to be taken up. If AS 16 allows it, then no problem. But if AS 16 doesn't allow it, interest is supposed to get excluded. This is payment beyond credit period. Then the next one, very important one, exchange of assets, barter. Exchange of assets. Now, I give one asset of mine to the supplier. Supplier will give his asset to me. So I am buying an asset and consideration is not given in cash. Consideration is given in other asset mode. If there is exchange of asset, then what should be done? Then recognition is done according to fair value. Recognition is done according to fair value. But even for this, there are exceptions. When you can have to go with the exception, two things. Either the transaction lacks commercial substance or fair value is not obtained. Any of the two circumstances. So either that particular transaction lacks commercial substance or fair value cannot be calculated. At that time, what will be the value then? At that time, consider carrying value of asset given up. Carrying value of asset given up. Carrying value of asset given up. So that's how you have to consider exchange of asset scenario, whereby if at all it is normal transaction, consider fair value. But if at all there is no commercial substance or there is no fair value, then consider carrying value of asset given up. Now a question comes, what is that commercial substance all about? What do we mean by commercial substance? So for that we have to see what are the indicators so that you can say there is a commercial substance. So those indicators are, number one, cash flow differentiation. Now, the cash flow of given up asset, okay, the cash flow of given up asset and the cash flow of received asset are different. Okay, if it is same, then there is no commercial substance as such. So indicator of commercial substances, the received asset and the given up asset has got two different cash flows. Second, the value impact is different, is significantly different. So the received asset, what value changes it's happening, either it is good or bad. The asset received value and the asset given up value are different. So value derivation for the company is different. So that's how commercial substance is established. One, the cash flow derived from the assets. Second, the value creation for such assets. So if at all the given up asset as well as the received asset has got a different way of taking these up, they say that there is a commercial substance. If it isn't there or if at all both are same, then it is lacking commercial substance. Most of the time in the exam they will tell you that there is commercial substance or not. So at that time just see how those rules are supposed to be applicable. Next, so we were dealing with the others situation. Now the third one will be, what happens if at all you purchase everything on a consolidated price? So one total price is presented by the supplier which contains more than one PPE element. Now at that time, how do you consider the calculation basis? For that we say divide consolidated price in rational basis. Maybe according to the fair value of individual assets, you divide the consolidated price to all those assets. Okay, so that's how it is supposed to be done. Then the other two ones are just for telling purpose. One, if at all it comes under leases, then consider according to AS 19. The last part, if it comes according to government grant, deal with it according to AS 12. AS 19 is there in the second group, but AS 12 is there in the first group, which is going to come on a later date. So this is how, if there is any other circumstances involved while doing our PPE calculation, this is how it is supposed to be done. So this is about the initial at recognition mechanism. If you buy it, if you self-construct it, and if there are any other circumstances. So that's how it is supposed to be done. Now, once you finish off with the at recognition principles, you have to then continue with after recognition principles. Have to deal with after recognition principles. Now in after recognition principles, the standard allows you to follow two models, either follow cost model or follow revaluation model. Either follow cost model or follow revaluation model. Now, in cost model and revaluation model, how do you calculate the subsequent value of the asset? The subsequent book value of the asset, we call that as carrying amount. So therefore, over here in cost model, carrying amount is calculated in what way? We say it is equal to 1 cost of the asset, which is according to at recognition principle, less accumulated depreciation then less accumulated impairment loss. So finally what you get is the carrying amount. Okay, now if I follow revaluation model, how can I calculate the carrying amount? So if I follow revaluation model, the carrying amount mechanism will be fair value of asset instead of cost, consider the fair value less subsequent accumulated depreciation less subsequent impairment loss. Again, what you finally get is the carrying amount. So this is how you calculate the carrying amount. When it comes to cost model, you will consider the cost mechanism. So for cost, deduct all the depreciation, impairment losses. So if value in use is less than the actual value or actual book value of the asset, we say that there is an impairment. So that impairment losses will be deducted from the value of the asset. If at all you go with revaluation mechanism, it is derived through fair value. So fair value less, we have to deduct subsequent depreciation, deduct subsequent impairment loss. So that's how you can calculate the carrying amount of these assets. Now, once you deal with this, there are certain common rules which you have to follow when it comes to this cost model and revaluation model. The first point to be understood in that is model will be an accounting policy. So specifically the standard itself told us that the model is an accounting policy. So very important thing that whenever you apply a model, you are not supposed to change it whenever you want until and unless conditions are satisfied. AS1, statute, standard, better presentation. So therefore, it is an accounting policy. They have to be very careful. Second, once you choose a model is applicable for class of PPE. So for the entire class of PPE, the model is applicable. Third one, what do you mean by class of PPE? Class of PPE basically means assets having similar nature and use. Okay, so basically, for example, there are office furniture. There might be n number of types of office furniture, but all the office furnitures has got similar nature and use. So that is one class. In the same way, say for example, a company owns residential buildings of its employees. So for residence purpose, the company gives it to their employees. Now that has got one similar nature and use. So that is one class. At the same time, company has got factory building. Now factory building and residence building are not the same because the usage is different, the nature is different. So therefore, factory building is one class, all the residential buildings are one class. So that's how you have to bifurcate your class of PPE. Assets having similar nature and use. So for all the assets under the class, you apply one model. So if I have chosen a class as office furniture, then if you choose cost model, entire assets of office furniture will come under cost model. So that's how you have to apply your model altogether. Later, one more point which you need to understand is if you follow revaluation model, then you have to revalue entire class. You cannot be choosy. You cannot say only this class I will revalue. Other classes, only this asset in the class I will revalue. Other assets I don't want to know. That's not possible. You have to revalue the entire class of asset. So that's how revaluation model, if at all you choose, that's how it is supposed to be applicable. So cost model, carrying value calculation, revaluation model, carrying value calculation. Now, certain extra things will come under revaluation model. Now, we have to see those things one by one. First, what is the frequency of revaluation? Now, first of all, if you are going with revaluation model, for what times you need to revalue the asset? Every month, every 6 months, every 1 year, every 3 years? What is the basis through which it should be done? For that, the standard said two things. One, if assets are highly volatile, or if assets are not so volatile, which means volatile basically means value changes due to market. If it's highly volatile where the market price keeps on changing or market price are there on a stagnant basis, at that time if it's highly volatile, then do it on yearly basis, revalue every year. Highly volatile example, all your electronic equipment, say mobile phones. So mobile phones, the market is too dynamic. At that time the value is highly volatile, yearly you have to revalue. Or if it is not so volatile, once in 3 to 5 years. Say for example building. So building, drastic changes in the value normally doesn't happen. Then go for 3 to 5 years revaluation. So that's how frequency of revaluation should be done. Later, how do you derive fair value? How do you derive fair value? For that, again, two situations have been given. One, there is market based evidence. So in the market, you can have a transaction for that asset. The asset is tradable in the market. At that time, fair value is market value. As simple as that. It tradable in the market, no problem whatsoever. Consider the market value itself as fair value. If there is no evidence, if there is no market based evidence, then at that time consider income approach, discounted cash flow, or any of the other similar types of methodology is adopted over here, which is, we call it as income approach. So that's how fair value derivation is supposed to happen. So fair value was there in the revaluation model. First you will take up the fair value, then deduct the subsequent depreciation and all. So for that reason, this is how it is supposed to be taken up. Now once the fair value is also known, the frequency of revaluation is also known. Next comes the accounting. Next comes the accounting. Now, accounting wise, there are mainly two requirements in accounting. Number one, how do you go with the values? And number two, what are the entries you are going to pass? So what journal entries will come? That is second one. How do you derive the values is first one. Now for value derivation, there are two bases through which it could be accounted for. So if you want to account it, consider it under two bases. Number one, you retain accumulated depreciation account. You do not retain accumulated depreciation account. Now, point to be understood, this is considered from revaluation basis. Don't get confused. So if you follow revaluation model at the beginning, how are you going to account for it? For that, two alternatives is considered. One, you retain that accumulated depreciation account, or you do not retain an accumulated depreciation account. Now, how do you derive values in each of the cases? Example, I will go with one example which I will try to apply for both the situations. Say first example, let's assume that the gross block of the asset is 1000 rupees. The accumulated depreciation on this is 400 rupees, and the revaluation amount, okay, after revaluation, say the value is 2000 rupees. Okay, so 2000 rupee is the value after revaluation, and 1000 is gross block, 400 is depreciation. That is the assumption of this example. Now, in this case, if at all I want to retain accumulated depreciation account, then how it is supposed to be done? First see that if gross block is 1000, depreciation is 400, then net block is 600, isn't it? Gross block is 1000, depreciation is 400, net block is 600. Now revaluation, after revaluation, the value of the asset is 2000. In that case, net block itself is 2000. The net block itself is 2000. How much increase is happening to net block? The total increase happening to net block is 1400. 1400 is increasing for our net block requirement. Now this 1400 will be divided in this particular proportion, will be divided according to that proportion. How do you derive that proportion? See, it will be 1400 into 1000 by 600, 1400 into 400 by 600. So basically you divide them, 1400 into 1000 by 600, 1400 into 400 by 600 according to the original requirement. To that extent you restate the gross block as well as the depreciation angle. Now if at all I consider the value accordingly, this is how the value will come into the picture. So this will be 2333, this will be 933 in the proportion basis. So according to the net block proportion, this is done. So 1600, 400, 600, accordingly it is done. Now take up the grand total. So gross block will become 3333, depreciation will become 1333, and obviously net block will now come as 2000. So that's how it is done. So if net block is revalued to 2000, proportionate increase is done for gross block, proportionate increase is done for depreciation also. Accordingly, net block will stay at the value at the revalued figure. So that's how one mechanism is done, where you retain accumulated depreciation, where you make certain proportionate increases to gross block and depreciation. This is alternative number one. The second alternative for amount basis, I will go with the same example. So basically gross block, depreciation and net block, where 1000 is gross block, 400 is depreciation and 600 is net block. Okay, now what is happening? The thing which is happening is now the revalued amount has come to 2000. So 2000 is the revalued figure. So accordingly, if 2000 is the revalued figure, then if 2000 becomes after revaluation, okay, at that point of time, 1000 is the gain under gross block and 400 will be the depreciation reversal. Total gain is 1400, which will lead to a 2000 net block. I will repeat it again. I think this you might have got confused. See, 1000, 400 and 600. 2000 is the revised figure. Now what I directly write is this itself is after revaluation. Okay, because 1000 gross block is now turning into 2000. Now why am I saying it? Because we are not ready to maintain accumulated depreciation account. We don't want it. We want to close it off. So therefore 1000 gross block now became 2000, because now gross block itself is net block, because depreciation accumulated should not be kept. So therefore 1000 became gain because of this particular transaction. 1000 before, 2000 after. Now this 1000 is gain out of the initial block. What about this 400? This will be depreciation account reversal. Depreciation is an expense. Expense reversal will lead to income, which means 1400 is the total gain, of which 1000 gain is recognized through asset account. 400 gain is recognized through reversal of depreciation reserve account or accumulated depreciation account. So that's how the second mode of amount calculation is done. First mode, you have got revaluation. You want to maintain accumulated depreciation account. At that time, net block, increase proportionately your gross block and depreciation. Second method, you don't want to maintain accumulated depreciation account, which means you will reverse it entirely. It will lead to gain. Second, the net gain is directly adjusted to asset. So that's how you consider two methodology of amount derivation when it comes to revaluation segment. Now from the entries point of view, how do you go with the entries mindset? For that we say, from the entries point of view, revaluation might be either upwards or downwards. Now if it's an upward revaluation, then it will lead to profit. This profit is an unrealized profit, because you are just revaluing it in your books and you are not actually selling the asset. Actual realization of profit will happen when you actually sell the asset. Till then it's unrealized. So therefore this profit is transferred to revaluation reserve account. If at all there is any profit, then it is transferred to revaluation reserve account. Then if it is downwards, it leads to loss. Whether it is realized loss, unrealized loss, whether it is capital loss, revenue loss, it doesn't matter. It will be transferred to P&L account. Okay, so because of this, what entry happened then? In this case, the entry will be asset account debit to RR account. In this case, the entry will be P&L account debit to asset account. However, initially there was a revaluation upward. So initial year we have passed an entry as asset account debit to revaluation reserve account. If at all in the future, because you know in a frequency the asset should be revalued all the time. So in the future, if the value reduces at that time, we call that situation as subsequent downwards. So if at all you are going to have a reduced value in future, at that time, what should be done then? First, reverse RR balance and remaining amount is transferred to P&L. Subsequent downwards means subsequent losses. How do you recognize subsequent losses? Do not transfer the entire loss to P&L. Instead, first write off the loss to already created RR account. Balance, if the loss still remains, transfer it to P&L. So what will be the journal entry then? It will be RR account debit to the extent of balance, P&L account debit for the extra losses to asset account for recognizing the loss in the asset. So that's how subsequent downwards of your asset will be considered. Then even in this case also, if there is a subsequent upwards, so initially you had a downward revaluation, because of that there was a loss. This loss was transferred to P&L. Now it is leading to subsequent upwards. At that time, just like the adjacent one, first recognize the profit for P&L already considered and remaining shift it to RR account. Say 10,000 loss was recognized in the previous year. Now you are having a 15,000 gain. Then first reverse the 10,000 loss you have already taken. First make it zero. And balance gain is transferred to RR account. So therefore, the entry in this case will be asset account debit to P&L for reversal purpose, then balance increase is transferred to RR account. So this is how you are going to pass journal entries whenever you deal with revaluation mechanism in the assets. So accordingly, this is the way journal entries are supposed to be passed. Now, once these things are done, a question comes, RR account is created. Now, can you use RR account to pay any dividend? The answer is no. Can I use RR for any revenue purpose? Again, the answer is no. You cannot use revaluation reserve for anything. Just recall yourself with the company law requirements that even RR account is not allowed to be utilized to give bonus issue also. For bonus shares issue also, they say exclude RR account, don't consider it. So therefore, do not use it for any purpose. Then how usage of RR account can be done then? Usage of RR account can be done when asset is disposed. If asset is disposed, at that time you can transfer the balance of RR account to P&L account. It's allowed to be done. But till then RR account will remain stagnant, or you can go with proportionate transfer according to depreciation. Go with proportionate transfer according to depreciation charged on the asset. Anyhow, you are reducing the value of the asset as depreciation. You also reduce the value of revaluation reserve as well and transfer it to P&L. But till then RR account has to remain stagnant. Do not use RR account for any purpose to that manner. Now, after this stuff, we take a halt on our asset mechanism, because almost everything in connection to assets are done. First, initially, what should we do? Subsequently, what should we do? How do we derive carrying amount? How individual models are adopted? Then, for this purpose of carrying amount only, there is another requirement which we need to go through, is about depreciation. What should we do with the depreciation mechanism and how depreciation are supposed to be formulated? So under depreciation, first thing what they say is component based depreciation. Now, what do we mean by component based depreciation? If part of asset has significant cost as well as nature also, compared to total cost of asset, at that time this part is depreciated separately. We call them as component based depreciation. So what is component based depreciation? Each part of an asset holds a significant position on the total value of the asset. At that time, you consider them as separate component and they are depreciated separately. Example, airway engines and airway furnitures are two different components, because both of them has got a different nature, both of them are having a major cost on the total aircraft. So therefore, since they have a separate material effect, they will be considered as separate components. Now, the next part of depreciation is how it is accounted. Depreciation is always transferred to P&L. Depreciation is always transferred to P&L. However, sometimes adjustments are made rather than transferring it to depreciation. Example, adjustment might be made to inventory or adjustment might be made to intangible assets covered by those standards. So that basically means if any assets are utilized for creating an inventory, it might be added to the value of the inventory itself. Or if at all there is any asset utilized for the purpose of creating an intangible asset, it could be added to the intangible asset because they are direct cost at that time. However, in all the other normal situation, it will be transferred to P&L. Now, when it comes to amount mechanism of depreciation, how depreciation amount recognition will happen? Depreciation is always levied on depreciable amount. According to what? Useful life. Okay, so depreciation is always levied on the depreciable amount over useful life. What do you mean by depreciable amount? It is cost minus residual value. Cost minus residual value. Okay, now useful life and residual value, two terms. Useful life, the time for which the asset could be utilized. Okay, one, residual value, the value which could be derived at the end of life of the asset when they are sold, scrap value. Now, both of them are estimations because both of them are decided at the time of purchase itself. So for how many years this asset might be used or what might be the value which could be derived, both of them are estimated at the beginning itself. Therefore, these estimates should be periodically reviewed. If there is any changes, then make the changes. And this changes is considered as change in accounting estimate. It's not a policy change, it's an accounting estimate change. So the point is, residual value as well as useful life are estimated at the time of purchase. Therefore, it should be reviewed on an yearly basis. Every time the business has to check whether residual value, useful life, whether they are same from the previous year or is there any changes. If they are same, no problem. If there is a change, then make the change, and this change will be considered as estimate change and not policy change. So this is when it comes to the useful life residual value mechanism. Now, after that particular part of this useful life and all, the fourth I can tell is depreciation method. What method is prescribed by the accounting standard? Number one, SLM is prescribed, straight line method. How do you calculate depreciation? Depreciation is basically cost minus residual value divided by useful life. This is SLM. Second, WDV, written down value method, diminishing balance method. How do you derive depreciation here? Depreciation is basically amount into rate, written down value into rate. Okay, then third, the other method allowed by the standard is units of production method according to production units. Units of production method, over here depreciation is equal to cost minus residual value into units produced during the year, units produced during the year divided by total estimated production. So of the total estimated production, how many did you produce this year? That will be considered for depreciation purpose. So that is, or these are the three depreciation method which is allowed by the standard, which we have to consider. Now, even in this depreciation method also, it should be reviewed every year, and if there is a change, then it could be done, and this change is again considered as accounting estimate change. Okay, so if there is any changes, then do it, no problem. You want to shift from SLM to WDV, no problem at all, you can do it, but that change has to be disclosed as an accounting estimate changes. So this is about the depreciation methodology which is involved in our AS10. Then afterwards, if you have land and building, how to make the treatment? Initially, when there was land and building, they used to merge these two accounts and depreciation was levied and all these things used to happen. But now they say land and building should always be shown separately. For land, there is no depreciation. For building, apply depreciation. Do not merge the two. So you have to bifurcate the cost of the land separately, building separately. For land, don't apply depreciation. For building, you have to apply depreciation. So this is how you have to deal with the land and building mechanism. So first thing has to be separated compulsorily, or it has to be separated all the time. Okay. Next, when do you commence the application of or commencement of depreciation? Commencement of depreciation is when the asset is available for use. Either it could be active use or passive use, it doesn't matter. The asset is available for use, then you have to consider depreciation from then onwards. So this is about commencement of depreciation. Now, when does depreciation come to an end? Cessation. Cessation of depreciation. When depreciation will come to an end? Now, depreciation will come to an end under two situations. Number one, when residual value exceeds carrying amount. So, when residual value exceeds carrying amount, stop applying depreciation. Asset is still with you, but don't apply depreciation. Okay. Reason being, if carrying amount comes below residual value, then asset should be shown at residual value. Do not start applying depreciation at all. Then the second situation is earlier of retirement from active use or derecognition. Retirement from active use or derecognition, whichever is earlier, will be the cessation time of depreciation. We have to check these two terms, which I'll tell you later. We have to discuss that in detail. But either you start applying depreciation, but it is going below residual value, stop it. Or it's not gone below residual value or something. Some other circumstances are happening. What are they? Either it is getting derecognized or it is getting retired. Whichever is earlier, stop applying depreciation. Don't apply it afterwards. Now, with this, depreciation will come to an end. But one thing, if I have to add up over here, whenever there is change in accounting estimate, then always give prospective accounting. What do you mean by prospective accounting? From date of change, apply it. You need not apply from a backdated effect. Apply it from the date of change itself. If I have to give you an example, 1 lakh is the value of the asset. Useful life is 4 years. Then after year 1, useful life is estimated to be 2 remaining years. So initially when I purchased, I estimated it to be 4 years, but now after year 1, at the end of year 1, now I am thinking that only 2 more years I may get instead of 3 more years. So useful life got changed from 4 years to 3 years now. How do you do it? You have to do it on a prospective basis, which means year 1 or after year 1, the value of asset has to be 1 lakh minus depreciation is 1 lakh divided by 4. So 1 lakh divided by 4 is 25,000. So 75,000 is the value of the asset. As on the date of change, the value of the asset is 75,000. For this, make the suitable different version. What is it? 75,000 is what? Year 2 value. And how many more years are there as useful life? Only 2 more years divided by 2. 37,500 will be the depreciation. Okay, so if there is any prospective change, first calculate the asset on the date of change. From then onwards, apply the revised term and finish it off. So do not go with a retrospective backdated effect. Till the date of change, calculate the asset value. Afterwards, calculate depreciation on the revised term of the values. So this is how you have to deal with the prospective changes. It could apply for anything. It could apply for residual value. It could apply for depreciation method. For everything, what should I do? 2 golden rules. 1, I will write it for you so that you will remember them. 1, calculate book value on the date of change. And this will be obviously according to the old method. Second, apply revised term from that date. So remaining how many years? Consider that and apply the revised value. So that's how you have to consider the prospective change if it happens for an asset. Then after this, if at all the decommissioning element which we mentioned before, where did we see this? We saw that in purchased asset perspective, that if there is any decommissioning which might happen in future, you have to estimate it now only and you have to add it to the current value of the asset, which means to that extent what you have estimated, you create a liability also. So when it comes to decommissioning, if it relates to future, at that time, 2 effects will be done. You will increase the cost of asset. At the same time, you will create a liability. So increase a liability. Now, what is this? This is estimated at the beginning itself, that after certain years, to dismantle or to decommission, there might be certain expenses which is incurred. Now, that expense will be estimated and written it on day one itself, which means the estimate might change. So, if the estimation is changing for this decommissioning estimate changes, if it's happening, then what should be done? You have to make the changes to asset also. So what should be done then? The thing what should you do whenever the estimation changes happen, it depends upon whether you follow cost model or you follow revaluation model. Then what might happen? In both situations, either the liability might increase or liability might decrease. The expense of decommissioning might increase, the expense might decrease. So that is the changes towards liability. In both the situation, just adjust it to cost of asset. Liability increases, increase the cost also. Liability decreases, decrease the cost also. So basically, if you follow cost model, no problem about it. Any change in the liability, make the changes to cost as well. If you follow revaluation model, again, liability increase, liability decrease. Okay, it will lead to liability increase or liability decrease. Okay, considering that if liability is increasing, basically it's a loss to me. So transfer this to P&L account. If liability is decreasing, it's a profit to them. Transfer this to RR account. So that's how, if at all revaluation model is done, it is done in this particular manner. If any changes is made towards that decommissioning element, suitable changes is done to these accounts. So this is how you have to consider the estimation changes may happen for your asset. Now, after this, those two terms, which are the last two terms which we have to discuss. One is, what do you mean by retired from active use? What do we mean by retired from active use? Now, it basically means that asset is ready for disposal in future year or ready for disposal in next year. So basically means that if at all the asset will be disposed in the next year, for the current year it became a current asset requirement. Because what does schedule 3 tell us? If there is any realization in the 12-month from the balance sheet date, it's current. So a non-current asset is now getting converted into a current asset. We call them as retired from active use. So therefore, when retired from active use takes place, at that time, what should be done? You have to make a valuation of it. So what is happening basically? The asset is getting ready for disposal in the next year, which means the status of non-current is now getting converted into current. At that time, you have to make a valuation. How the valuation is done? Either value this at cost or value this at fair value, whichever is less. And this amount will be transferred towards that current asset element. If there is any profit, ignore. If there is a loss, transfer it to P&L. This is how you have to consider the retired from active use mechanism. What about derecognition? Now, derecognition can happen in two situations. Recognition, bring the asset. Derecognition, delete the asset. And how deletion of asset can take place? Deletion of asset can take place in two situations. Number one, either it is disposed, or number two, future economic benefit is not available. Because if future economic benefit is not available, recognition criteria is not met, derecognize. So that's how it should be understood. Now, if this derecognition during disposal, how it might happen? It might happen in three ways. Either you make a sale, or you transfer the asset in finance lease, because under finance lease, as you remember in AS1, substance over form will apply, which means the lessee is going to show the asset in his books. In my books, it gets derecognized or disposed. Third one, if you give it as donation, you transfer the asset as donation. So in these three situations, it leads to disposal. Disposal will lead to derecognize. Or if future economic benefit itself is not derivable, then derecognize. Whenever there is derecognition, any profit or loss is transferred to P&L account. Whenever you make a derecognition, if there is a profit or loss, it is transferred to P&L. How do you calculate profit or loss? Is equal to net consideration or sale proceeds minus carrying amount. So that will be your profit or loss. This profit or loss will be transferred to P&L. So this is how you have to consider how do you take up the AS10 requirement. Okay, these are the theoretical aspects. You could see there are a lot of points in AS10. So remembering them to some extent is difficult. So therefore these chart based presentation is given to you. So that one by one, when you look into that, you are going to get a clear idea about how those points are supposed to be taken up. So read that charts properly whenever it is given. Anyhow, I have given it in the description box. So look into that and download it and read those charts properly. Start correlating to that, and automatically you will keep on realizing that AS10 requirement, it has to come in this particular way. So now we have finished off with the theoretical aspects of AS10. We have to now move towards the problem based. Let's move on with that. Okay, so this first question is an RTP question which is given. I'll quickly read up the question. Omega Limited contracted with a supplier to purchase machinery which is to be installed in its one department in 3 months' time. Special foundations were required for the machinery which were to be prepared within this supply lead time. The cost of site preparation and laying foundations were rupees 1,40,000. These activities were supervised by a technician during the entire period who is employed for this purpose at rupees 45,000 per month. The machine was purchased at 1 crore 58 lakh and 50,000 transport charges were incurred to bring the machine to the factory site. An architect was appointed at a fee of rupees 30,000 to supervise machinery installation at the factory site. You are required to ascertain the amount at which machinery should be capitalized under AS10. So basically in this question, what's happening here? We are purchasing the asset, purchase machinery, and it will be installed in our department in 3 months' time. So in 3 months' time, this is going to be installed. So the time allotted is 3 months. Special foundations were required to the machinery and the cost of site preparation were 1,40,000. Remember, cost of site preparation is a directly attributable cost. It is allowed to be added to the value of the asset. Next, these activities were supervised by a technician who is employed for this purpose at 45,000 per month. What is that per month mechanism? 3 months time, which means into 3. He will be supervising any cost incurred to make sure that the asset is properly functioning will be added to the value of the asset. So 45,000 into 3. Then purchase price is 1 crore 58 lakh, obviously added. Transportation charges is a direct cost, so that will also be added. And finally, architect will come under professional fees. Even that is also a directly attributable cost. Even that also should be added. Once you add all these stuff, you are going to get the total value of the asset. So here is the solution for this thing. See, 1 crore 58 lakh, that is the purchase price. For this, site preparation is directly attributable cost, 1,40,000. Technician salary is 1,35,000. So 1,35,000 is 45,000 into 3. As I have told you, it will be considered accordingly. Then transportation charges is 50,000. Architect fee is 30,000. take up the total, that is the total value of the asset. These kind of questions are very simple if it comes in the exam. 5 marks you can easily score. You just have to remember what are those addition points when it comes to asset. Suppose in this 45,000 if there is any internal profit, make sure that you eliminate it. Do not consider internal profit altogether. This is the solution for one of the questions. Then this is the MTP question, which is the recent MTP question, mock test paper. It is that question. I'll just read it up again. We'll analyze that and we will see what is the answer of it. Entity A carried plant and machinery in its books at rupees 2 lakh, which were destroyed in a fire. These machines were insured for new for old and were replaced by the insurance company with the new machines of fair value 20 lakh. The old destroyed machines were acquired by the insurance company and company did not receive any cash compensation. State how entity A should account for the same. So what is happening? Entity A had a machinery worth 2 lakh that got destroyed and they had a new for old policy, which means old asset will be taken over and new asset will be replaced with it. So that is the policy. Therefore, for this insurance, there is no cash flow. There is no compensation paid. That is what is mentioned over here. They did not receive any cash compensation because the insurance itself is new for old insurance. So therefore, they took up that destroyed asset and they gave an asset to the company worth 20 lakh rupees. How are you supposed to recognize this is what they have asked. First, don't go with the notion that this is asset to asset exchange. No, asset has got destroyed, which means destroyed asset what you have, you should derecognize it. Destroyed asset you derecognize because that asset is now getting out of the books without any cash. So since you are derecognizing, remember the derecognition provision. What does it tell? There is a profit or loss on derecognition, it should be transferred to P&L. Here there is a loss, transfer it to P&L. Okay, then what else is happening? You need to recognize that new asset coming in. New asset, whatever came in, should be recognized. For that, did you pay for it? No, I directly received it. That recognition is now leading to profit. But don't take the net of figure. Consider them separately. Old destroyed asset, derecognize, no cash received, loss, P&L. Then new asset which is received, that is supposed to be recognized without paying any cash, gain, P&L. That's how you have to bring out your answer for that particular question. So if I have to read the solution of that, entity A should account for a loss in statement of P&L on derecognition of the carrying value of plant and machinery in accordance with AS10. Entity A should separately recognize a receivable and a gain in the income statement resulting from the insurance proceeds once receipt is virtually certain. The receivable should be measured at fair value of assets provided by the insurer. So that's how it is supposed to be understood. Now second one, Omega Limited, a supermarket chain, is renovating one of its major stores. The store will have more available space for store promotion outlets after the renovation and will include a restaurant. Management is preparing the budgets for the year after the store reopens, which include the cost of remodeling and the expectation of 15% increase in sales resulting from the store renovations, which will attract new customers. Decide whether Omega Limited can capitalize the remodeling cost or not as per provision of AS10. Remodeling cost. So this basically means what? Remodeling cost is a subsequent cost. Subsequent cost capitalization, do we remember? What does subsequent cost capitalization tell us? If asset recognition criteria is met, capitalize it. Otherwise, no. What is asset recognition criteria? Future economic benefit should flow to the enterprise. Cost should be reliably measured. Now, if you could see here, it gives us more available space and it increases sales by 15%. Which means because of this remodeling, there are chances, there is probable that 15% sales will increase, future economic benefit. Obviously, the cost is obviously reliably measured, not specifically given in the question, but it is reliably measured, which means you can capitalize the remodeling cost. So that's how they have given it in these 3 lines. The expenditure in remodeling the store will create future economic benefit. Moreover, the cost of remodeling can be measured reliably. Therefore, capitalize according to AS10. So that's how your answer has to come. Every time analyze the situation, accordingly bring up the answer. So this is supposed to be AS10 requirement. We have seen all the theory. It's a bit vast, but and also the problems. Once you know how theory could be interpreted, problems will automatically become easy for you. With that, let's end the discussion of AS10 and we have to now start with AS3. So now AS3 talks about cash flow statements. We know that there is separate chapter on the preparation of a full-fledged cash flow statements and all, and it is a full-fledged question containing different angles, different provisions, etc., etc. So I will not be dealing with those type of questions altogether because it is coming under a separate chapter itself. I will only be covering those elements which are important from those 5-mark question which is covered up in our accounting standard base. So I will be covering only those accounting standard based questions over here. Separate chapter of cash flow statement, you have to refer it in that chapter itself. Now talking about this cash flow statements from the theoretical angle, from the understandability angle, and how that 5-mark question which could be asked in the exam. Now when it comes to cash flow statement, it is basically flow of cash and cash equivalent. So basically in cash flow statement, we look into the analysis of how cash and cash equivalent flew in that particular period for that particular year. Now, when it comes to cash flow statement, so basically it's a statement which tells how utilization of cash and cash equivalent has taken place. Now, what do we mean by cash then? Cash is basically cash in hand and demand deposits with bank. Okay, so cash in hand and demand deposits with bank are covered under cash definition. What do you mean by cash equivalents then? So first, it is a short term, highly liquid investment which has an insignificant risk. Okay, so cash equivalent is a short-term, highly liquid investment having an insignificant risk. Now, first thing, what do you mean by short-term? Short-term from AS3 angle, we say that less than 3 months or 3 months or less. That will be short-term. So, anything less than 3 months is considered for cash equivalent short-term purpose. What about highly liquid investment? Is easily convertible to cash. It could be easily converted into cash. It should not take more time. Third, insignificant risk. So it is no risk involved. So for that particular instrument, there has to be very small risk or no risk altogether. So for example, say there is a bank FD of 2 months. First, short term, yes. Can this be converted into cash easily? Yes. Is there a risk? No. Consider this as cash equivalent. Treasury bonds. Anything less than 3 months which is issued by the government, we can consider that as cash equivalent. No problem at all. Can I consider a 10-day term ka equity share? The answer is no. Why? Even though it is short term, even though it is highly liquid, it has got risk. So because of that, do not consider that as cash equivalent. So if anything comes under cash equivalent, it doesn't come under investment. It will come under cash and cash equivalent itself. So it will be coming under that particular head. The next thing what we have to know is, what do you mean by cash flow? Cash flow basically means inflow or outflow of cash. So inflow or outflow of cash is cash flow, and it is a cash flow statement. So therefore, all the non-cash items are not considered for cash flow statement at all. Depreciation is a non-cash item, does not come for cash flow statement. Profit or loss on sale, there is no cash. For sale there is cash, profit or loss there is no cash, which means it does not come under cash flow statement. So those are the things which should be excluded. Now when you do indirect method and all, you make the reversals over there just for the reversal sake, you bring it, otherwise it doesn't form part of cash flow at all. So that's how you have to consider the cash flow mechanism. Now once you prepare the cash flow statement, all these cash flow are divided into activities, and three activities we have: operating activity, investing activity, and financing activity. Operating activity, investing activity, and financing activity. In what do we mean by operating activity? Principal revenue generating activity, principal revenue generating, or other than investing and financing. So operating activity is one. Major business activity what is going to take up is operating activity, or investing and financing, it's not possible, put it in operating. So that's how operating activity comes into the picture. All your general business requirement like cash sales, receipt from debtors, then salary, rent, etc. All these things are operating activity because it is related to our main business. So that is considered under operating activity. For example, even for these financial institutions, for them, dividend and interest are operating activity. Why? Principal business. For a trading concern, sales is their major business. So for them, interest is their sub extra income earned. That will not be operating at that time. But for financial institution, earning interest itself is their main business, which means that itself will become their operating. So you have to see from the business to business point of view. Then investing, anything related to long-term assets and investments. In the sense, long-term investments. Okay, which means if at all there is any purchase or sale of assets, fixed assets I mean, or interest and dividend received as well. Because anything related to long-term assets and investment are a part of investing activity. So for a trading concern, interest is received. How did you receive? You made an investment, investing activity. You received dividend. How did you receive? You invested in shares. Then it became your investing activity. So interest and dividend received is a part of investing activity for trading concerns. Last, financing activity. If anything changes owner's capital or borrowings, it will be considered under financing activity. Anything related to owner's capital or borrowings, which basically means, example wise, issue of shares, redemption of debentures, and important one, interest and dividend paid. Interest and dividend paid. So interest you are paying. Why? Because you have a debenture. You have issued a debenture, you are paying interest. There is a borrowing, you pay financing. You are paying dividend. Why? You have a share, owner's capital, you are paying financing. So that's how financing activity comes into the picture. So if I make an investment and I receive anything out of it, investing activity. If I make a capital or borrowing and I pay anything out of it, it's financing. So that's how you need to consider these activities altogether. Then when it comes to operating activity, the calculation of operating activity could be done in two ways. One is direct method, second one is indirect method. Now, under direct method, how it is done? It is basically cash receipts minus cash payments. Anything related to operating cash receipts and cash payments, receipts are added, payments are deducted. That's it. What about indirect method? Indirect method, it will be profit before tax taken as base and made all adjustments. Adjustment related to non-operating, adjustment related to non-cash, adjustment related to working capital, everything is done. Finally, what you get is your operating activity cash flow. Since this is related to the main chapter of cash flow statement, I will not deal with those format of those particular topics. So I will not be considering that. I'm just giving you an idea. When it comes to indirect method, it depends upon PBT, and according to PBT, you make suitable adjustment to get your values. The next part, when it comes to investing and financing activity, it is directly related to direct method, in the sense any inflow of investments are positive, outflow is negative, take the total and show it. In the same way for financing as well, there is no indirect method mechanism for those two terms. Finally, whenever you have got individual transactions, it is never allowed for a net off, in the sense there is sale of machines. First I'll write it. Yeah, there is sale of machine, purchase of machine. Don't net off and show the single amount. So sale separately, purchase separately. So that is how you have to do it in cash flow statement. You are not supposed to take the net of L. So first, when it comes to activities, analyze the business, see the situation and decide. Principal business, operating, investment related, investing, owner's capital and borrowing related, financing. And later, net off is not allowed in this particular cases. Other than this, everything is related to that main chapter of cash flow statement. So I will not deal with those extra elements. Standard wise, this much is more than enough for you to write it in the exam. So with this, the theory sector of AS3 is over. Now we have to move towards a problem and see how it could be solved. I'll quickly read up the problem now. Prepare cash flow from investing activities as per AS3 of Messrs. Shubham Creative Limited for the year ended 31/3/19. Machinery acquired by issue of shares at face value. Claim received for loss of machinery in earthquake. Unsecured loans given to associates. Interest on loan received from associate company. Pre-acquisition dividend received on investment made. Debenture interest paid. Term loan repaid. Interest received on investment, TDS of 8,200 was deducted on the above interest. Purchased debentures of X Limited on 1st December 18 which are redeemable within 3 months. Book value of plant and machinery sold, loss incurred 9,600. So this is the question we have here, and accordingly we have to see how the calculation will be done. First, see what question they have asked. Cash from investing activities. So those individual activity questions will be asked when it comes to 5 marks. Now, if you could see one by one, let's analyze and discuss about it. Machinery acquired by issue of shares at face value. Issue of shares at face value. So to acquire the machine, you are giving them shares, which means this is a non-cash item. If it is non-cash item, it should never come in cash flow statement. We have already seen that. Only cash flow. Cash inflow or cash outflow is considered. Next, claim received for loss of machinery in earthquake. Claim is received, which means this is investing activity. Agreed. But this is an extraordinary item. Now, extraordinary item, there are different way of interpretation, but normal interpretation is whenever there is an extraordinary item, if it could be specifically applied on a particular activity, consider according to that activity, but show it as a separate line. So if at all there is an extraordinary item which is related to financing activity, show it under financing, show it under investing, show it under operating. If it is not specifically ascertainable, put it in operating. That's how we normally consider the extraordinary item mechanism. Here it is related to investing activity, so consider it under investing activity. Next, unsecured loans given to associates, investing activity. Loan given to associate, loan given to investee people, therefore it's an investing activity. Interest on loan received from associate company, again investing activity. Associates are my investment people, I received interest from them, investing. Pre-acquisition dividend received on investment made, investing activity again. Debenture interest paid, this is financing activity, don't get confused. Debenture interest paid, why did you pay interest? Because you issued debenture, borrowings, it is financing activity. Term loan repaid, again financing activity, because term loan is repaid, borrowings are repaid, financing. Interest received on investment, 8,200 TDS was deducted from the above interest. Interest received on investment, first of all, is investing activity. And what is happening? 73,800 is what we have received. 8,200 TDS has been made. What is the concept? Total interest, some part will be deducted as tax, deposited with the government. Balance amount will be received by the company. That is how taxation works. So what is happening actually? Add the two. This is your actual interest. Actual interest is 82,000. 82,000 is interest. 10%. 8,200 has been deducted by the person. Balance has been given to us. Which means for us, cash inflow is 73,800 itself. There is no doubt about it. But when you present it, show them separately, which is gross interest 82,000 minus 8,200 TDS. Do not directly write 73,800. Show as a presentation 82,000 gross, 8,200 TDS. So that's how it is supposed to be done. Next, purchased debentures of X Limited on 1st December 18, which are redeemable within 3 months. Now, purchased debentures of X Limited is investment, agreed, but they are redeemed within 3 months, short term. Redeemed, which means highly liquid. Then it should have less risk. Debentures normally don't have a risk. Shares have risk. Debentures normally don't have risk, which means this is a cash equivalent. If it's cash equivalent, it doesn't come under any activity. It is directly analyzed as cash flow. So over there, it will be checked. Finally, book value of plant and machinery sold, loss incurred 9,600. Book value is what is the value in the books of accounts. Book value sold is 90,000. Whether in book value there is cash flow? No. There is the cash flow, sale proceeds. So after making sales, you are incurring a loss. What does that mean? If book value is 100, sale value is 90, 10 rupees loss. Why did you say that? Because sale is made at less than book value. Here what they are saying, this sale led to loss, which means you have made the sales at less than book value. Again, this basically interprets that 90,000 minus 9,600 is my sale proceeds. And in sale proceeds, there is cash flow. Book value, there is no cash flow. And obviously, this is investing activity because it is related to a long-term asset. So this you have to bring it in the answer. So if you could see now, unsecured loan given to associate 5 lakh, interest is 70,000, dividend 52,600, interest received on investment in inner column 82, less TDS 8,200, then outer column. Sale of plant and machinery 90 minus 9,600. Extraordinary item will be shown separately. Claim is received, therefore it is positive. So when it is positive, cash inflow. When it is negative, cash outflow. So this is how you have to calculate your cash flow elements whenever an accounting standard based question is asked to you. So this brings an end towards AS3. AS3 is a simple one because the rules and regulations are quite small. AS10 had a more rules and regulations, and accordingly we completed both these standards. So I hope everybody understood these two standards altogether. Any doubts, uh, post it in the comment box, or you can uh, contact me through the social media accounts. I will be ready to give details to any doubts to that manner.